Okay, the topic business income is obviously very broad. And so really it should probably be titled Introduction to Business Income or Fundamentals of Business Income. And a lot of this we've already touched on in the first couple of classes that we did as we tried to lay the foundation. And now what we're going to do is we're going to start to build on that foundation just a little bit. But in the first class, we still stay fairly broad in our coverage. And so the first thing we have to look at is what is business. You know, we have an understanding of it, but does the Act define it? As it turns out, the Act does. In Section 248, where they give most of the definitions in the Income Tax Act, this definition is given. A business includes a profession, calling, trade, manufacture, or undertaking of any kind, and an adventure or concern in the nature of trade, but does not include employment, an office or employment. Okay, so the paraphrase of this is basically a business is a money-making venture that is not employment. Okay, so again, what we're doing here is we're introducing the fact that, yeah, you know what, there's buckets out there, and it's easy to put people into business buckets and employment buckets, and isn't that really easy? Well, as it turns out, in a lot of cases it is. In most cases it is. And near the end of the course, we'll look at those cases where it's not so obvious. But for now, we'll just assume that this distinction is easily made. We can identify a business and we can identify employment and we can separate them. But understand, of course, that just like anything else, this is really on a spectrum, and the distinctions are not as clear as we're making them here. However, that's the first thing we want to talk about today. Second thing we want to talk about is something we've definitely met already, and that is the separation of income and capital. Okay? So income and capital being separated, and we're hopefully starting to get a sense again here. We have this, the analogy that we like to use is that we have a tree and we have fruit on that tree. So there are the apples, okay? And we like to think of our income coming from our apples and the tree being our capital. Okay, but again, this is all on a spectrum because there are people who sell trees. There are companies that sell trees, and if you sell trees, well, then trees are your inventory, and so therefore it's income. Okay, so the key takeaway here is that context matters. Okay, you cannot know whether a specific transaction should be treated as capital or income until you know the facts surrounding that transaction. Okay, so the textbook offers this idea of, basically what we want to know is how do I recognize an income, and how do I recognize a capital? So, is there a litmus test? Can I pour some chemical on it and have it turn blue, and then I'll know for sure that it's income? And the answer is no, you can't. So the text offers this Exhibit 4.1 and basically says, here's some guidelines. And so what I'd actually like to do is look at this in reverse and say, okay, here's what you want to figure out. You want to figure out, is it capital or is it income? Okay, that's what you want to figure out. Well, how are you going to do that? You're going to do that by determining the intention. Okay, so this all comes down to intention. And one of the difficult things about intention is that it's hard to prove, right? It's hard to identify, first off, because most of the time we're looking at things we're looking back to see what was your intention. We can see the outcome, but we don't know what your intention was. And so it's a very difficult thing to prove. So the textbook, so a lot of these things end up getting litigated. These things there's court case after court case where the CRA says this was income and the taxpayer says no, it was capital. And because every case is different and the facts around it are different. So they give you these, what they call badges of trade. And really the paraphrase I use for this is the duck test. So I don't know if you're familiar with this kind of phrase, if it walks like a duck and quacks like a duck and Looks like a duck. It's a duck. And basically what we want to do is we want to look at as many angles of this thing as possible and say, okay, yeah, from that angle it looks like income, from that angle it looks like a capital. How are we going to sort this out? But at the end of the day, it is what we're trying to get at is intention. Okay, so the whole thing is intention. But what we want to do is say, okay, and so they give us some guidelines. So the relationship to the business, the how it fits in, the nature of the asset, how often do you do this? If you're selling these things all the time, then that sure doesn't look like a capital asset. Length of period, etc. Okay, so you can see those in your textbook, and we're going to go through those in one of the problems that we do. Okay, but at the end of the day, this is not something that the Act is able to say, here is the right answer in all cases. Okay, and so we're going to look at an example of where we have to sort this out. Okay, so that's the second thing that we wanted to do. And then the third thing that we want to do in this video is we want to get an introduction to how do we get to income for tax purposes. Okay, and really, so again, we've already talked about this, so this part is not brand new, but our starting point will be financial accounting net income. Okay, so GAAP net income. Okay, so we're going to start from that. And so what we need to acknowledge, and really what this ends up being, is really a series of true, false, yes, no questions. So to get from GAAP accounting, so from GAAP to tax, we're just going to do a whole, whoops, that's multiplying. We're going to do a whole bunch of adding and subtracting to get from there. So we're going to take things out of GAAP income that shouldn't have been there. We're going to put them in. Okay. So at the end of the day, what we're doing is we're answering a series of questions. Each of those questions is really this: do GAAP and tax agree that the item, so the expenditure, like this happens on the income side, but they very rarely disagree on the revenue side of things. So this is almost, we always think about it in the context of the expense. So what we'll do to kind of separate it out is we'll call it an expenditure. So that the expenditure, the outflow, when you spend money, do they agree that the expenditure is an expense? So we're going to, and what we're going to say, remember in the tax world we use the term deductible. Okay, so this is the question that we're going to ask over and over when it comes to, should this be included, should this be added back? What we're really doing is saying, do they agree? And if the answer is no, they don't, tax says it should be and accounting says it shouldn't be, or vice versa, then what we have is we have a permanent difference. Okay, so that is, they don't agree. One of them says it's an expense and the other one says it's not. Okay, so interest and penalties will be our example of this. Accounting says, sure, that's an expense. Tax says, no, it's not. So we'll talk about the treatment of how these things work. The much more common thing is that, yeah, they do agree. They agree that it's an expense. That's the most common outcome. But we have another decision node here. Do they agree, once we know, yeah, they agree they're expenses, do they agree on timing? Okay, so do they agree? Yeah, they agree that it's expense, but do they agree that it should go to the income statement at exactly the same time? And again, so we have separate treatments here. Yes, if they agree, then there's going to be no adjustment, right? We're not going to need to do anything. If they agree on the timing and they agree that it's an expense, then we don't have to do anything. Okay? But if they don't agree, then we have this thing called a temporary difference. Okay? And this will be our most common outcome because we're going to choose things where they disagree so that there's some controversy. Okay? And so what we want to do is we want to make this less, I'm going to shrink this down a little bit. What we want to do is make this not mysterious, not it's going to start to feel mechanical, but we really want to build our intuition before we start to get into these rules, and so that we have something to check the rules against, an intuition to check it against. So when there's a permanent difference, we are going to either add or subtract that from GAAP income. So if it's not there, we need to put it in. If it is there, we need to take it out, and that's it. When they agree, we're going to do nothing. That's one of my best talents, doing nothing. So we're going to do nothing there. And then the most common one, when they agree, what we're going to do is we're going to do 2 steps. We're usually going to add, and I'll just leave out the subtract. Just say add back what accounting did. So whatever accounting did, we're going to add it back, get its effect out of net income, and then step 2 will be the subtract the tax effect. Okay, so, and I don't want to put tax because you're going to get, so how about we do this? Add back the accounting version of things. So the accounting version of this expense and the tax version. And so what we really want to do is the net number is what matters. We want that to be in net income for tax. But the process we normally use, and again, we've seen this with depreciation, whatever accounting did, add it back, get it out of there, and then we'll start from a baseline of 0, and we'll take the tax effect, the CCA. Okay, so this is the key. If we can understand that what we're really doing is each time we see a line, we're deciding does this need to be adjusted or not. What we're really saying is do GAAP and tax agree? If they do they agree on the timing? If they don't, okay, here's how we'll do it. We'll add back the temporary effect here, and then we'll take out the tax. Okay, so hopefully that helps, and helps get you going on the stuff that we need to do for class. And please note that I have added, so I'll put it right here. We've added problem 4.7. I've already put this on Learn, but I want you to, it's not on the syllabus. You need to prepare that for class 2. It's in your, it's in the starting points, and it's posted everywhere. Okay, thanks.